And the last thing I want you to remember is if you have a profit motive in your business, you get to have your Schedule C and you get to keep every single receipt and take every single deduction that is entitled to you as a business owner, as a freelancer, and it has nothing to do with whether or not you itemize. Welcome to the Sunlight Podcast. In this show, we're talking about taxes, money, and careers for creative people who have a big vision for changing the world with their work. I'm your host, Hannah Cole, artist, tax pro, and the founder of Sunlight Tax. If you're an artist, designer, or creative entrepreneur who wants to grow your business sustainably, manage your taxes, and build a stash of fuck you money so you can control your own time and have a bigger impact with your work, you are in the right place. Hello, how are you? Today on the Sunlight Podcast, I want to clarify something that I see people make mistakes with all the time. This is really, really important because it is one of the most key structures inside of your tax return. And yet most people I find are confused about it. So today I am going to explain the difference between itemized deductions and business deductions. These are completely separate things. They have nothing to do with each other. And yet many of you confuse them, conflate the two things. So it's very, very important to know that you are fully entitled to your business deduction so long as you have a profit motive, and to know when it is and how to know whether or not you itemize or take the standard deduction and what that means, okay? Because that has a big, big effect on your taxes. It is one of the things you should know. So I'm going to teach you how to know whether you itemize or take the standard, and I'm going to teach you the difference between itemized deductions and your business deductions, which you're going to get. Okay, so let's get started. Here's a scenario that I see all the time in my tax practice. Somebody who's a new client will come in the door and they'll say, oh, wait, my accountant told me I don't itemize. And so I threw out all my business receipts. That to me is a tragedy. I want to prevent all of you from going through that tragedy. If you have said that before, I hear you and I understand, and I am going to break down why you are so confused about that. And we're going to tease apart the key issues. All right. What is itemizing? And what are your business deductions? Okay, business deductions are the deductions you are allowed to take on your Schedule C. Your Schedule C has an alternate title, and you can go check your last year's tax return to find this. It says profit or loss from business activities. That's a Schedule C. Who gets to file a Schedule C? Schedule C is for those of us running creative practices, but it's also for anybody who's a freelancer or sole proprietor, or even a single member LLC. So if you're a freelancer, contractor, consultant, single member LLC, you get to file a Schedule C. The only thing that is the qualification for whether you're entitled to a Schedule C or not is whether or not you have a profit motive. In other words, that this is a money-making endeavor. You are trying to earn a living from it, or at least a partial living from it, and it's not a hobby, okay? So if you would classify it as a hobby, okay, you're not using a Schedule C, you're not allowed to. But so long as you're trying to earn income from it, right? So even just a little bit of freelance income, then you get to file a Schedule C, okay? Profit motive is what entitles you to a Schedule C. Understood? And when you have a Schedule C, very important to know, the structure of the Schedule C is that you have to report all of your gross income. So that's all the income you make from that activity. But you also are entitled to take deductions. And so it's very important that you track those deductions. Otherwise, you don't get to actually take them, right? And you need the receipts for them. And certain other categories of deductions you don't get receipts for, such as, when you drive your vehicle, you're not going to get a receipt for every mile you drive, right? So there's other ways to track certain special categories like mileage, home studio. P.S. all of you, I have put in so much work on this very beautiful visual guide to your tax deduction. So if you have not yet downloaded that on the Sunlight Tax website, I really encourage you to download that because I made it for your benefit. It has all of these rules written out on it, and it's visual, right? I know that a lot of us are visual learners, not just those of us who are visual artists, but it is a one-page PDF guide. You can print it out. It's all up to date as of today's date. Print it out, put it above your desk, and boom, you've got all the rules just laid out for you all the time. So it's a really, really valuable resource. I made it for your benefit. Please get it. It's at sunlighttax.com/deductions guide. That's deductions with an S, deductions guide. sunlighttax.com/deductions guide. So that's there for you, that one-page visual guide to the Schedule C business deductions. Go get it. Okay, so your Schedule C, you're reporting your gross income, you're reporting your deductions, and when you know those two numbers, there's a magical third number that allows you to come to, which is how much profit did you have, right? So you're actually only, so long as you're tracking all those deductions, you're only going to be taxed on your profit, okay? Super important, super important. So you're only taxed on your profit, and that is why you're going to track all those deductions, because it's your legal obligation to report all the income, but you don't have to pay tax on all the income so long as you are documenting your expenses as the law requires. Okay, that's your Schedule C. Those are business deductions. We call them business deductions. Now, I never, ever, ever want you to use the word itemizing when you're talking about your business deductions. And there's a really good reason why, because people get confused over what business deductions are, and they think they're the same thing as itemizing, and they are not. So if you come away with nothing else from today's episode, I want you to understand that itemizing is something totally different and absolutely unrelated to taking your business deductions. Okay. So what is itemizing? Let's get into it. So on your 1040 tax form, there are all sorts of different schedules that plug in. And the different schedules basically exist because different buckets of income that you might get from different sources and activities have special tax treatments. Like not all income is treated the same way. And so we create schedules. Tax law has created schedules to separate out different types of income that have their own tax treatments. So basically, that's the point of the schedules that go on your 1040. Now, there's all kinds of different schedules. They have different purposes. For today's episode, you don't have to remember what all of them are, but you may have some and you may not. And it's okay. You only have to fill out those schedules that actually apply to your life and your income. And if you don't have a particular type of income, you're never going to have to bother with that schedule, right? So a Schedule F is for farm and fishery income. Hey, if you're not running a trout farm or trout fishery or farming, you don't have to bother with a Schedule F. Okay, so it's pretty cool. But you might have certain schedules. If you have rental income, that goes on a Schedule E. If you have capital gains, that's going to go on a Schedule D. Dividends and interest, Schedule B. Schedule C is for your business deductions, your self-employment. And actually the Schedule C, in case you're curious, like one of the major functions of a Schedule C is actually to calculate self-employment tax. So in other words, whatever goes on a Schedule C is subject to self-employment tax. That's a really important function of your Schedule C. But there's juicy, awesome benefits on the Schedule C, like the fact that you're allowed to take losses, like the fact that you get deductions. We'll get into those things on a future episode. I want to stick to today's topic. Now, the Schedule A is where itemized deductions go. Please notice the Schedule A, itemized deductions, is something completely different from the Schedule C, which is where your business deductions go. Okay, here's me, tax pro, telling you these things are completely separate. They are not related. They are not dependent on each other. You can have one without the other. You can have both. You can have neither. Okay, they're not related to each other. Okay, so Schedule A. What is a Schedule A? What is itemizing? What is an itemized deduction? Here's the basic thing, and I want all of you to pay attention because It's totally bananas to me that we do not get a tax education in this country. And this right here, whether you itemize or take the standard deduction, this is one of the very core pieces of your knowledge about your own tax return. You want to know whether you itemize or not. Okay, that's really important information for you as a taxpayer. And I'm going to teach you how to know and what the role of it is. Okay, so pay attention. Even if you think this is irrelevant to you, I'm telling you it's very relevant. So here we go. We built the US tax code so that every single taxpayer gets an initial chunk of their income tax-free. Okay, all of us, you, me, Warren Buffett, doesn't matter. Your first chunk of income is not subject to income tax. That's pretty cool. It's nice. It's a benefit. Now, you can either get that first tax-free chunk as a fixed amount, and we call that fixed amount the standard deduction, or you can get your tax-free chunk of money at a variable amount, and that variable amount we call itemized deductions. Okay, so the thing that I want you to tie together in your mind is itemize versus standard deduction. Okay, those two things are interrelated, and it's an either or. You either do one or the other. Okay, who itemizes and who takes the standard deduction? Let's get into it. And I'm gonna get a little into equity stuff and the civics behind this, because I think we should teach civics in high school. I think we should teach taxes in high school, but we don't. And so here I am trying to get us all up to speed. So the standard deduction is a set amount, okay? And most US taxpayers take the standard deduction. Chances are good you take the standard, okay? Chances are good, in other words, that you do not itemize. 90% of US taxpayers take the standard deduction. Who does that leave? 10% of taxpayers itemize. Only 10%, okay? So the standard deduction is a fixed dollar amount, and it increases just a little bit with the cost of living every single tax year. Generally, the IRS comes out with those rates in the fall for the following year or 2 years. Okay, so for 2022, the tax year whose taxes you'll be preparing once 2023 comes around, the standard deduction for 2022 is $12,950 for a single taxpayer, single filer, or if you are married filing separately. If you are a joint filer, so if you're married filing jointly, we double that and it becomes $25,900 because there's two of you. And if you're head of household, that means you are single, but you have at least one dependent, then that standard deduction amount is kind of in between those two numbers. It's $19,400. Okay. So if you take the standard deduction and you are single, your first $12,950 of income that you earn is not subject to income tax. Another way that we could phrase that is saying that your income tax rate for your first $12,950 is 0%. Okay. So that's pretty cool. If you're a low income person earning income, you don't generally pay income tax, right? If your income is that low, below the standard deduction amount. Okay. Super key. Super key. Okay. Now, who itemizes and what does it mean to itemize? Well, remember, you get a choice between whether you're going to take the standard deduction or whether you're going to itemize. And because you're allowed to choose whichever one you want, except small asterisk, if you're married filing separately, you actually have to do what your spouse does. And so that's one scenario where you might have to take one that isn't to your advantage. So just small asterisk. But generally speaking, most of us get to pick the one we want. And the logic just goes, you pick the bigger number, right? You pick the bigger amount of tax-free income. That's pretty logical. So you're basically going to look at which number is bigger, the standard deduction, which is going to be a set rate that you can look up on the IRS website every single year. And for 2022, it's $12,950 for a single taxpayer, double that if you're married filing joint. Or if you itemize, you're going to itemize if your itemized deductions are higher than the standard deduction amount. If you have more itemized deductions in combination than the standard deduction amount, because you're going to pick the bigger number, right, of tax-free income, non-taxable income. Okay, so what are the itemized deductions? Basically, itemized deductions are 4 things. Okay. These are what I want you to remember. These 4 itemized deductions. Number 1, and the biggest kind of indicator one, is mortgage interest. Mortgage interest is one of your key itemized deductions. Number 2, state and local taxes. State and local taxes capped at $10,000. You only get up to $10,000 of this. P.S. In the 2018 Republican tax law changes, they capped this to $10,000. It used to be infinite. It used to be if you paid $60,000 in state and local taxes, you'd get a $60,000 itemizable deduction. No longer. Number 3, charitable contributions are itemized deductions. And number 4, medical expenses, but only when they exceed 7.5% of your adjusted gross income. So just a little quick math for you. If you have $100,000 in adjusted gross income, then your first $7,500 of medical expenses are not deductible at all. Only your $7,500 first dollar is your first dollar of deduction, right? So if you spend $10,000 on medical, you get a $2,500 medical itemizable deduction if you have a $100,000 AGI. That was a lot of math. I hope you caught that. But basically, the kind of upshot is you have to have very, very high medical expenses to even get a single dollar of deduction. So absolutely, in a year where you get in a car injury or have a major, major catastrophic event, then yes, that's a year you definitely do want to track your medical expenses. And it's a year you might actually itemize, even though normally you don't. But it's a pretty high floor before you actually even get to take medical. So generally speaking, like young, healthy people without, traumatic events are generally not going to get a single dollar for medical expenses. Okay, so let's review. Mortgage interest, state and local taxes capped at $10,000, charitable contributions, and medical expenses only once they exceed 7.5% of your adjusted gross income. Those are your key itemizable deductions. So what does it mean to itemize? If I take all 4 of those categories of things I might have spent money on in the past year and add them together, if the added amount is higher than the standard deduction, so close to $13,000, right? $12,950 for a single filer. If my itemizable deductions are higher than the standard deduction, I will itemize because I get to pick the bigger number and it's tax-free. So I'm going to pick the bigger tax-free number. Okay. So, like as a baseline, who gets to itemize? Typically the person itemizing is a more well-heeled person. It's typically somebody who owns their home. Now, why would that be? Mortgage interest. So mortgage interest is a big factor in itemizing. And so if you have really high mortgage interest, because there's no cap on that, then that will tend to push you towards being an itemizing taxpayer. That doesn't mean that everybody who has a mortgage interest actually itemizes. In fact, there was a big shift in 2018 when the tax law changes came in. We had a new Republican president and a Republican Congress, and part of their mandate when they were elected was basically revamping the tax code. They passed a big tax law. So one of the things that Congress did with taxes was they doubled the standard deduction. Okay. Now the standard deduction used to be about $6,000. They also eliminated this thing called the personal exemption. You don't even have to remember what that is anymore because they eliminated, it's gone. You don't get it. I don't get it, but it used to be a factor in our taxes and it is no longer. Back in 2017, you would itemize if you had itemizable deductions that were over roughly $6,000. But in 2018, they doubled it to a little over $12,000 for the standard deduction. And so that means you didn't itemize until much further into itemizable expenses. In other words, you had to have a lot higher amounts of mortgage interest, charitable contributions, medical expenses, or state and local taxes, except they capped those at $10,000 where they used to be infinite. So effectively what happened, you don't have to remember every detail there, but what I do want you to understand is that effectively in 2018, there was a big shift in how taxes worked, where pre-2018, about 35% of the US taxpaying population itemized, and post 2018, only 10% itemize. Okay. So the effect of doubling the standard deduction was to eliminate a lot more people from taking itemized deductions. Okay. They kind of booted people out of that boat. So what's the upshot? What happened? Well, essentially, a lot of people who used to itemize, who pre-2018 actually were itemizing taxpayers, post-2018 no longer itemized. Now they became people who take the standard deduction. I am actually a taxpayer like that. We used to itemize in 2017, 2018. We didn't have mortgage interest, state and local tax, charitable, medical that exceeded the standard deduction anymore, because as a married filing joint taxpayer, that was around $25,000 in those expenses we would have need to had to itemize. So I take the standard deduction now, and I used to itemize. Now, here's what I have found as a tax practitioner. I have found that a lot of people had conversations with their accountants around the time of that tax law change, where their accountants said to them with great concern, because it was new and the accountant's trying to inform their client, they said, hey, you don't itemize anymore. And the accountant was correct in what they said to you, but a lot of people heard it in a way the accountant didn't intend, because a lot of people, and this isn't your fault, this goes back to the fact that we don't give a freaking tax education in this country. Have you noticed I have a little beef about this? Anyway, so a lot of people didn't realize what itemized deductions actually are. They thought that meant their business deductions, because a lot of people use the word itemizing about their business deductions. And please don't do that, because it causes this confusion. But a lot of you thought that your accountant was saying you don't get your business deductions anymore. Now, the accountant would have been horrified if they had realized that was the misinterpretation that was happening. Many of them never realized, because communication between client and accountant tends to be pretty terrible. Standards are low. So I found a lot of clients came to me and would say, my last accountant told me I didn't itemize, so I'm not keeping my business receipts anymore. And I would be like, oh no, that's terrible. You're totally entitled to all of those business deductions. Nothing ever changed. Your Schedule C never got touched in this whole thing. And what they were doing was, in their head, they were confused. They thought that itemized deductions meant business deductions, and they do not. They're not related. They have no relationship. They're totally independent. Okay. So I hope I've helped you clarify the difference there between itemizing, which is, to review, mortgage interest, state and local tax capped at $10,000, charitable contributions, and medical expenses that exceed 7.5% of your adjusted gross income. So I hope I've helped you clarify the difference between itemizing, which goes on your Schedule A, and only 10% of US taxpayers do. And most of those taxpayers are going to be homeowners, because mortgage interest is a key component of itemizing. So typically a renter is not going to itemize. So I want you to take away from this that you should keep all your business receipts, so long as you have a profit motive, so long as your freelance activity, your sole proprietorship, your single member LLC, so long as there's a profit motive there and it's not a hobby, then you are absolutely entitled to file a Schedule C, and on your Schedule C, take all your business deductions. Okay. Does that make sense? Awesome. Now there's a little bit more civics I want to catch you up to speed on. And I feel motivated to do this because, the fact is, like, you cannot advocate for fair tax law if you don't understand what the tax law is. So let's get you kind of to understand the equity issues going on behind the standard deduction versus itemizing. When I said state and local tax used to be deductible infinitely, but now it got capped at $10,000, in my humble opinion, please don't send me hate mail about this. I do have political opinions. I'm going to just be honest about that. But in my humble opinion, when that law was passed, it was passed along party lines. It was a partisan tax bill that was passed, and capping state and local tax deductions to $10,000 where they used to be infinite was the most partisan thing in that bill. Why do I say that? Well, the fact is, high tax states states where the citizens of the state, such as New York State, such as Massachusetts, states where the citizens of that state had elected representatives based on their priorities who, prioritize things like public safety, healthcare, education, public schools. Those are the things that states pay for, right? There's no military at the state level, right? You're not paying for that. You're paying for, generally speaking, education, healthcare, and public safety. That's what state taxes, state and local taxes go to. If you elect representatives and you say, we agree as a populace that we believe in paying our taxes so that we get the benefits of safety, education, and health, then the federal government had a deduction for state and local taxes that kind of took some of the sting out of being in a high tax state, right? Because you could deduct the entire amount of tax that you paid to your state on your federal income taxes. Now, to me, if you elect those people, you have had a say in that already, right? But in the 2018 tax law change, the legislators capped the deduction to $10,000. This meant that a lot of people who used to itemize don't anymore. And it took, on average, I think it was about $30,000 of deduction away from people primarily in blue states. So that was, in my opinion, the most partisan part of that tax bill. Okay, please don't send me hate mail. I'm just trying to tell the facts, but yeah, okay, maybe that's the most opinionated thing I'll say today. Now, a couple other things I want you to know about itemizing. So itemizing can be a really great benefit if it actually applies to you because it's infinite. You can take infinite itemized deductions, but most of us don't have, most of us who are middle and upper middle class, working class, we don't have itemized deductions that are high enough to itemize, right? So it used to be 35% of the population itemized. Now it's only 10. The people who itemized are higher income people, and they get a pretty unlimited itemized deduction. So if you give charitable contributions that are millions and millions of dollars, you're allowed to deduct them. There are some rules. You can't take a deduction for more than 50% of your income for the year. So you carry forward the rest, but you don't lose it. You still do get the deduction. Most of you don't need to know the wrinkles of that law because it will never apply to you. That particular rule applies pretty exclusively to people in the top 1 to 2% of earners. So charitable contributions are only deductible if you itemize. In other words, 90% of US taxpayers don't get any dollars off for their charitable contributions. To me, that's not really cool because proportionally, the lowest income Americans actually pay the most percentage-wise of their income towards charitable, which I think is pretty wonderful. There's an incredible generous spirit in this country, really and truly. The numbers bear it out. And I think if you are a low income person spending a massive percentage of your income on charitable donations, you should get the same benefit on your taxes that the 1% get. That is opinion. That's my opinion, but there you have it. You might be thinking, oh, wait, I thought I got a little bit of charity in the last couple of years. So I will just say there's always exceptions in tax law. But during COVID, because Congress was trying to pass some laws for the COVID era to incentivize people making charitable contributions and recognizing that some people would be affected and some people would be less affected by COVID restrictions, Congress passed a limited time only charitable contribution deduction that applied for standard deduction takers. That was $300 for an individual or $600 for a married filing joint couple. So you did get a little bit of your charitable contributions in the last couple of years. I'm afraid to say that that is going away. And if you want my opinion on tax policy, I think it should get extended. In fact, I think it should be even more generous to reflect the full charitable contributions of middle class, working class, and low income taxpayers. But there you go. I don't know if you wanted my opinion. I guess if you're listening to this show, perhaps you did. So in other words, there's some equity stuff built into the tax code. Oh, and the last equity thing I want to bring up is renting versus owning. So Congress did make the mortgage interest deduction a part of itemized deductions deliberately because they wanted to give a tax incentive and a tax benefit for home ownership. There is much in the tax code that benefits homeowners, and this is one of the key places where that exists. Now, why is that? Why has Congress historically favored home ownership? Well, the logic is that home ownership creates more stable communities. It creates an incentive. When you own your home, you are incentivized to take good care of it and to invest in it and invest in your neighborhood, and that it creates more neighborhood stability. Those things are true, right? That's legit, I think. But it also has some bias built into it, whether it's deliberate or accidental. I'm not even going to venture there, but it does have some bias in it because if you think about it, who rents, right? People who are younger, people who are lower income, and people who have been historically left out of homeownership, right? And that's not an accident, right? There were redlining laws. It was legal to discriminate against people of color in housing up until not that long ago, historically, right? And so home ownership has been heavily favored in the tax code, but also US policy has kept Black and Brown and Indigenous people out of home ownership through actual laws, the allowance of redlining, the inability for enslaved people, for example, to pass down property or even own property. So there's historic inequity in the tax code that just reinforces who benefits, people who were able under the laws to own a home versus people who historically were left out of home ownership. And so, it's just a thing to know about. It's a thing to know exists. There are ways to mitigate this. I will say the state that I grew up in, the state of Massachusetts, took a measure and they put a piece in their tax law. The Massachusetts tax code has a provision for renters. It actually has a rental deduction. And the role of the Massachusetts renters deduction is actually to mitigate some of the inequity built into that prioritization of homeownership. So I just want you to know that there are some ways to address it at the state level. You could advocate for this perhaps in your state. And if you lived in Massachusetts, you could advocate for a higher renter deduction. There are ways to work on this. But it's also interesting to note that by doubling the standard deduction federally, we have also booted a lot of people who used to itemize into the same camp as everybody else who takes the standard deduction. And it has actually taken some emphasis off of homeownership prioritization, right? Because it used to be 35% of Americans, of US taxpayers, got that benefit, and now only 10% do. So it's reduced the number of people who have that benefit. So it's just a thing to think about, something I want you to know. Okay, that was a lot on the civics, but you know what? I love it. Tell me what you think. Tell me if you kind of like the civic side of taxes. I think it's super important to be a good citizen, to kind of know where your money is going. Let's talk about how you know whether you itemize or not. Okay, because it's really important to know if you itemize or don't, because if you, for example, know that you are nowhere close to the limit between itemizing or taking the standard deduction, that you don't have to bother tracking your medical expenses, for example. Okay, so there's things, or your charitable contributions, right? So it's kind of nice to know if you itemize or not, and also how close to itemizing you are. So maybe you don't itemize, you don't have high enough expenses to itemize, but you're kind of close to it. And so maybe you might have a decision point coming this year about making an expense or not, because it could be a year where you might push over the limit and become an itemizer. So here's how to check. You can take out last year's tax return, and you can take a look at line 12A. It's right on the front page. Line 12A tells you if you itemize or not. Okay, so just take a look there. You'll notice that where that line 12A actually has a little pull-out section to the left, and it actually tells you right there, it has the numbers for that year's tax return standard deduction amount. So take a look at those numbers. It says, here's the number for single, here's the number for head of household, here's the number for married filing joint. And if one of those three numbers is the number that's on line 12A, more than likely what that means is you're taking the standard deduction at that amount. Okay. Now, if you have a number that doesn't look related to any of those numbers in the pullout, in other words, not related, a different number from those set amounts for the standard deduction, that means you itemize. Okay. And that number should be higher than the standard deductions amounts because you only want to itemize if your number's higher. If you happen to be married filing separate, you might be forced to itemize even when your itemized number is very low. So that's the one group that has a concern there. Okay, so line 12A, last year's tax return, that is how you check to see if you itemize or take the standard deduction. And now you can know. And the last thing I want you to remember is if you have a profit motive in your business, you get to have your Schedule C and you get to keep every single receipt and take every single deduction that is entitled to you as a business owner, as a freelancer, and it has nothing to do with whether or not you itemize. So PSA to all of you, please don't use the word itemizing when you're talking about your business deductions because it helps perpetuate that confusion among people that they think that itemizing has anything to do with their business, and it doesn't. So I hope that you listening now have come to realize what the difference is, and you will never be confused. And you will also be able to look at last year's tax return and know which camp you sit on, itemizer or standard deduction taker, and know that regardless of which one of those two things you are, you're still entitled to all of your business deductions. Cool. So I hope that really helped you clarify some confusion you may have had. And I hope I taught you something about the tax code and the civics behind it and why we set things up the way we did. Now, as a next step, if you have a profit motive in your business, it really behooves you to be tracking and getting every single deduction that you are entitled to. And that's for your benefit. That's because that keeps your taxes as low as they are legally allowed to be. And that's a wonderful thing. So if you need help with that, and you have not yet downloaded my visual guide to your deductions, I recommend you go to my website now and take a look and download that. So you can go to sunlighttax.com/deductions guide and download my one-page, colorful, visual guide to your tax deductions. It has all the rules for things you need receipts for, and actually the categories where you're not going to get receipts, but what the rules are for tracking those as well. So I built it so that you can just print out that one-page PDF, paste it up by your desk or wherever it is you do your bookkeeping, wherever you do your taxes, and you just have it there as a resource for you. And I update it every year. So go get that guide, sunlighttax.com/deductions guide. And I hope that you got a lot out of today's episode. If you did, please send me a DM on Instagram at Sunlight Tax or send me an email. And I hope this has been helpful to you. All right. Thanks so much for listening, everyone. Thank you for listening. If you like the show, be sure to subscribe, leave a review. It really helps, and share it with a friend. I'm so grateful. This podcast is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links we reference at sunlighttax.com/podcast.